What are some strategies to acquire investment properties by the end of the year? All right, so depending on when you're watching this particular live stream, it could be at the top of the year, could be at the end of the year, but right now we're about month 8.5 into the year. So if you want to still acquire rental properties before 12/31, here's a few things that I would consider doing. Number one, I would definitely go ahead and work with a broker or a real estate agent to help you map out how much you can afford. Number two, you need to identify where that down payment is going to come from. If this is going to be your first rental property, more than likely the banker will require you to bring 20 to 30% down to the table. So you want to make sure you have access to that money, whether it's through a HELOC on your primary residence, whether you might be taking money out of some type of retirement accounts, whether you're taking money out of your savings. You want to do the math to make sure that wherever that money is coming from, you're not going to go into the hole to get that money. Number three, you want to do an analysis on these properties. You want to make sure that that property is going to cash flow, particularly if you're not purchasing the property for tax purposes, okay? If you're not purchasing the property for tax purposes, you want to make sure that that property is going to cash flow, or if it's not going to cash flow, that that property is in an area that is accelerating quickly or rapidly. So when we're doing an analysis for our clients to help them determine if this property is a good property to purchase, we're looking at a four-legged stool calculation. I want to know, how quickly is it going to take us to build equity in this property through principal reduction? I want to know, is this property going to help us from a tax perspective? I want to know how rapidly the property is appreciating in value. I also want to know the cash flow. So if you think about a four-legged stool, that stool is the most stable when that stool has four legs. So out of those four options, if it has all four of those options, that is probably a really great property, and you probably need to go ahead and lock that into place. But let's just say one of those legs is missing. That stool still has three legs. Still pretty sturdy. So don't let one thing that's off about that property convince you that that's not a great property to purchase. But if you're missing two out of the four legs, you need to start side-eyeing that property. It would have to be something so miraculous for me to still purchase or even advise a client to purchase that property. Because again, it's not very sturdy at this point. It only has two legs. So there are some areas of the country that's appreciating 8, 10, 12% right now per year. If I ran across the property and that was the only leg, one of the two legs, or maybe even the only leg that was still standing, I might be losing a little bit on the cash flow front. It may not be helping me in taxes, but I'm still paying out some principal. That still may be a pretty good property to purchase because of how rapidly the real estate is appreciating in that area. You may be losing $1,000 a year on cash flow, but that house may be gaining equity and appreciating $15,000, $20,000 per year. You cannot overlook those types of factors just because the property is not cash flowing. Now, if cash flow is king for you and nothing else matters, then you have to figure out what your investment objective is and apply that investment objective to your search. But if that's not your investment objective and that's not your goal, then that may be a good property for you.